Welcome to Investors Hangout. What we used to call till last week Money Hangout is now being called Investors Hangout. It better reflects what we talk about, what we actually do, uh, help you understand investment issues, answer your questions, and so it's not mundane money issue. We don't talk about credit. We don't talk about how to purchase or spend your money wisely. So it's all about investment. So it better reflects what we actually do. So welcome to Investors Hangout. Every week we will be doing what we used to do, which is take your questions, help you understand investment issues. This is brought to you by Birla Sun Life and Value Research. Today we are going to talk about something which we have referred off and on. Every now and then we keep talking about it. It very well fits into, it is very important for us to help you suggest ways which simplifies your investment life. It helps you simplify how you invest and in an uncomplicated way, in an uncluttered way, and in a manner that you can understand. And this is a question which a lot of people ask me nowadays. The hybrid funds have come to life. They have become a very prominent part of the investment universe, of the investment landscape. What used to be on the peripheral, nobody used to ask about the balanced fund or the equity income fund or anything. And in a rising market, understandably so, these are not the hottest part of the market. But I think the way people are embracing mutual fund, the way even the fund companies are acting in a slightly measured way. They are not trying to capitalize on the market rise to aggressively sell something which sells well or is a high performance fund. Everybody is suggesting investors that they should be investing with an understanding. They should be investing in a calibrated way. They should be investing in a manner that they are not disappointed, because most of the time there is absolutely no problem with the kind of investment where investors invest. The problem is the kind of investment that you choose and the expectation that you come up with. Those expectations are never met, because mostly investors come to make investments in an inappropriate investment at a time with a huge expectation, which is a clear recipe for disappointment. And for any investor's need, I'm generally referring to long-term investors. For any investor's need, you need to really you need some mix of equity and debt. What should be the mix? It depends on the time frame. It depends on your temperament. If you are a first time investor and if you are making a long term investment, but you are extremely you are extremely worried investor, you will be extremely disappointed with a big decline, maybe a 20% decline in 6 months time, and you will be very disappointed. For those investors, you need to really think of a allocation. Everybody needs equity, and every equity investor, any aggressive investor, also needs fixed income, which means that you need to really mix it up. And how to mix it up is a way. This actually presents a question to you, which is which fund to choose and how to mix it up, which is the most appropriate fund for you. So I would say that broadly, and most investors can actually do it themselves, but the fund route is simpler. Assuming that you think of a dominantly equity portfolio and a nominally fixed income portfolio for your long term. I'm not referring to your fixed income allocation, all the money which investors need to consume in next 2-3 years time, and in a definite time frame. That should definitely be finding its way into fixed income. I'm talking of long term money which should also follow some asset allocation. If you're a long term equity investor, then you should consider 80% into equity, remaining into fixed income, so that you can periodically rebalance. If you are an even more conservative investor, you should think in terms of 50% equity, 50% debt. If you are an extremely conservative investor, then you should consider a small allocation to equity, 20-25% equity, because equity is important even for the extremely conservative long-term investor, because you will not be able to beat inflation. And how to do it with simplicity? There are funds available. The balanced fund, which we keep talking about every now and then, that is the simplest way where long-term investor should be able to participate in equity, get the benefit of active management and periodic rebalancing, without any tax implication, because if you invest 75% into equity, 25% into debt, market goes up by 10%, you want to move your money from equity to fixed income or move your money from fixed income to equity, all those transactions will be liable for taxes. When you invest in a balanced fund, the fund manager does all that for you, and you are not liable for taxes till you hold your fund investment for 1 year and more. So that's a simpler way of doing it, and consider that actively. But balance fund, and there is one, so any investor looking at long-term investment avenue, and that too deriving return from equity with greater stability, should consider a balanced fund. All those investors who are little more conservative, they should consider a 50% allocation to equity and 50% to debt. Consider those equity income funds and other things which are available. There is a set of fund. There are quite a few funds which are actually targeting that allocation, and they are also able to derive the equity treatment for taxation. So consider those equity income fund, equity saving fund. They can come in handy. For the ultra conservative investor, but they are long-term investor, they should embrace little risk. They should embrace little risk, and the way to embrace that is consider the growth options of the monthly income plans, the MIPs, where they can actually have 15 to 20% allocation to equity. They are dominantly debt fund, but the packaging of it, they come in a very neat package. You don't have to worry about it. I wish some of these MIPs had even lower expenses, but the simplicity with which you are able to derive this allocation, with which you are able to invest, derive little more return, and so choose the appropriate fund. These are the three ways to actually achieve an asset allocation: conservative, aggressive, and moderate. Try and do it with one or two funds, and that is all, and these funds can actually fulfill the needs of most investors. This is way to mix it up, and this is way to mix it up with simplicity and convenience, tax efficiency, and this should be the way most investors should start their investing. And for many investors, that is the only thing that they might need.
Thanks, Dhiren. We have a number of questions lined up. In our first question,
Yeah.
Abhijit asks what the difference between an equity-oriented hybrid fund and a balanced fund is. He says that a number of equity-oriented hybrid funds have a 95% equity exposure. So how can they be hybrid?
No, I can't think of a hybrid fund which is, which has 95% allocation to equity. Ideally, it should not be. There must be something. The way they are actually investing in the arbitrage position, because the arbitrage position sometimes actually lead to a misleading reporting, because arbitrage position sometimes, they actually look like equity allocation, but by the very character they are not equity. So there could be some kind of misreporting going on, or his understanding. But generally I would agree with him that the aggressive hybrid funds are the ones which value research refers to as balanced fund, and it is a misleading name. They are not balanced. They are actually, dominantly equity fund. They invest up to 70 to 75% into equity, remaining into fixed income. And there is a history to this. Why they are called balanced fund? Because they actually originally started as a balanced fund. Balanced fund used to invest 51% into equity, 49% into debt many years ago. Then the tax laws changed. The tax law changed to say that for a fund to be treated, and the tax treatment of equity and debt from a taxation point of view is different. So, and all the gains from equity funds are considered tax free if held for over 1 year, and the short term gains is taxable at 15% if held for less than 1 year, if you buy and sell before 1 year. So these are concessional tax treatment. So what happened was the tax fellows decided that the equity allocation should be for a fund to be treated as an equity fund, it must invest 65% and more into equity. And that is when most mutual fund companies who were running the balanced fund changed their allocation. Then, just to comply with this, they had a 5% extra leeway that it might sometimes give, just to not be precise, keep some headroom for that, so that many a times the equity appreciates, and if you actually slip below 65%, it will be wrong. So they kept it to 70%, and that is how these balanced funds became an unbalanced fund. But it's a matter of time, I think whatever you call it, hybrid aggressive or balanced fund, but they are 70, generally they are 70% equity remaining into fixed income. They provide greater stability, they don't crumble. And there is one thing which investors should be wary of. Many investors are expecting regularity of dividend from these balanced fund, and they think that it is a bankable investment in income avenue. Many a times it could be disappointing.
Our next question also springs from this confusion about hybrid fund categories. Om Prakash asks what the difference between an equity savings fund, a balanced advantage fund, and a dynamic equity fund is, and which of these is preferable in the current scenario.
Many a times, it depends on the fund company, because it's not a very regulated thing. Everybody tries to, except for the dynamic allocation fund, which tries to attempt an asset allocation by investing in equity and debt depending on, so there is no frozen allocation. The fund has ample flexibility. The fund can invest anywhere. The fund can be substantially into equity. The fund can be substantially into debt. The fund manager's mandate is to run an equity or debt portfolio and be fully invested in it or completely out of it, depending on his outlook for the market, for the various segments of the market. If the fund manager thinks that the market is extremely expensive, it is poised for a correction, and it decides to be completely out of equity, it can well do so. So apart from the dynamic allocation fund, the other two, the names are being used interchangeably, but depends on the fund, from one fund to another. Very soon we will have a law. The SEBI is contemplating a regulation whereby they will classify funds. They will actually mandate what fund stands for what, and every fund company will have to slot their funds into those categories, and that will actually simplify things further. But many a times these are used interchangeably. The only thing you have to worry about is that sometimes the allocation to equity slips beyond. Many a times some of these funds are trying to some of the equity income funds and other things are actually looking like 35% fixed income, 35% equity, a third in equity, a third in fixed income, and a third in arbitrage position. So it gets the tax treatment of an equity fund, but the underlying characteristic of a fund is two-third fixed income. Two-third fixed income from an investor's experience point of view, in terms of investor's return point of view or risk point of view, and two-third into equity from a taxation point of view. So that I think is quite interesting. You can be a conservative investor investing in those funds, but you need to really find out, because different fund companies are actually stating it differently.
Some investors also have doubts about the management structure of balanced funds or hybrid funds. Mr. Rajagopal asks if the equity and debt portions of balanced funds have separate managers, then who do not work in tandem, then should he separately invest in equity and debt funds?
No, the efficiency of a balanced fund, because it is able to do the active rebalancing on a day-to-day basis, is way too valuable. It is very efficient. It gives you the advantage, and you should not consider investing in both the things, because think of it. If you invest, assuming that you have decided to invest 70% into equity, 30% into debt, and you invest ₹1,00,000, you plan to invest ₹1,00,000 now. So you invest 70,000 into equity, 30,000 into debt, and then tomorrow equity goes up by, or say in 3 months time it goes up by 20%. So your ₹70 becomes 84, and the fixed income has gone up only by 1%, which means your ₹30 has become ₹33. Now your allocation looks very different. It is no longer 70-30. If you go about rebalancing it, then there will be tax implication. When you invest in a balanced fund, the fund manager will be doing it, and it will have absolutely no tax implication. You will not be liable for any taxes. So the efficiency of balanced fund is great. I don't think there is any disconnect. There is any kind of poor chemistry or anything. There are two fund managers, because there is an equity portion of a balanced fund, there is a debt portion of a balanced fund, and they decide that the fixed income manager is actually managing the fixed income part, and the rebalancing happens by way of design. So I don't think two fund managers, it is not that there are two different fund managers and they're opposing each other. They have a very defined duty. They have to build a great bond portfolio for this balanced fund. The other fellow has to manage the equity portfolio very well, and the rebalancing of it depends on a day-to-day basis. And I think that will be a very mechanical function at fund company, where the dealing function will make sure that the fund manager, if the fund has to sell some equity or debt to align the allocation, that I think is a simpler thing.
Next up, Ramanathan says that if a fund underperforms its peers for more than 18 months, he can cancel his ongoing SIPs in it.
Yeah.
But what should he do about the accumulated amount?
About
the accumulated amount?
I think the reason why if you have decided to discontinue your investment because it is not doing well, so for that very reason, you should also move the money to the place, to the destination, which is going to be the alternative. But one should just be careful about the tax implication. If you are investing in a fund, it is not doing as well as other funds, but you still might be sitting on gains. And if you realize those gains, you'll be liable for 15% short-term capital gains tax for the investment made within the last 15 months, last 12 months. So your investment of so just time it a little bit to, for it to be tax efficient. The other thing is that for different categories, for some funds, 18 months might be a good enough time, but for others, 18 months may not be a good enough time for you to actually form an opinion that the fund has not done well.
Next up, Atul, who has got a lump sum from the sale of some property, says he wants to do an STP into a hybrid fund. He asks what the duration of the STP should be.
There isn't a rule as such, but if it is a very sizable amount, and if it is going to be so sizable that it's a once in a lifetime kind of situation, where the sale proceeds realized from the sale, from his investments, then I think it should be over a long period of time. I would say that the longest period I would think of will be about 3 years, because one will be able to catch a good part of any market cycle. Assuming today, any time period I see, because if you spread it over an even longer period, then investments, your investment will not be put to work at all. So it depends on generally speaking, one should be guided by the scale of money and how important it is. If I am going to invest my annual bonus, then I would like to invest that money over the next 3 to 6 months. That will be good enough. If this is the money which which is my superannuation benefit, all I earned it for a life, generally I would like to invest the money. The time it takes for me to earn that much money, I would like to spread that money in half the time period. But why I am saying, but the maximum period should be 3 years, simply because spreading your investments beyond 3 years, the money will not be put to work.
Next up, Bhupendra says that his father recently retired with a good retirement corpus. A relative who is a Sahara agent suggested a scheme which he said will double in 5 years. He asks if he should invest in it.
No, one is that he should definitely not invest. He should worry about it, and he should spread the word in the community so that nobody else gets caught there. Sahara, there are different kind of investment companies around of Sahara, which is collecting money. Even if they might be legitimate, making a promise of this kind, doubling money in 5 years, is a fairly aggressive promise, and fairly aggressive returns too. And the residuary non-banking financial company is in trouble. SEBI is trying to find the investors who invested in that in that company, and so it's best avoidable, because and there is a precedence. I think one should worry about it. He will do a favor by ensuring that not too many people get involved in this.
In our next question, Arjun asks if hybrid fund should be part of the portfolio of everyone above the age of 35. He also wants to know how they differ from the NPS in terms of asset allocation.
Hybrid funds are, I think for all individual investors getting started, hybrid fund should be the only way of putting your long-term money, because most investors and get started with their investments, and the moment they see a big decline in a brief period of time, which is the nature of the market, which is the nature of the fund, you will have to face that. They get very scared, and they get out of the market. They get in the market at an inappropriate time. They get out at the most inappropriate time, and then get out to never come back again. So it's very important for investors to always get initiated with a balanced fund. For somebody very young, after 2-3 years of investing in a balanced fund or a tax saving fund, which is the way to start, then you should consider an all equity fund for some of your specific goal oriented investments, which are very long off in far off in future. You can have an all equity funds, but I think most investors should start with a balanced fund, or start with a hybrid fund to begin with. Then different kind of hybrid fund, as I explained earlier, that it should be dependent on how much comfortable you are with the market, what kind of time have you spent, and how have you experienced it. If you have never experienced it, it's always good to err on the side of caution. You should be more conservative with your allocation.
He also wants to know how they differ from the NPS in terms of asset allocation.
Yes, NPS is very different. One is that NPS, the tax treatment, the asset allocation, and your liquidity is completely different. When you invest in a balanced fund, hold it for 1 year, end of the story. You can take your money out, all the gains are tax free. If you invest in a balanced fund, it will be 70% fixed equity, 30% debt. So liquidity, tax efficiency, you see here. NPS is little different. One is that you can't take your money out from the NPS tier 1 till you are 60. The maximum allocation possible in NPS is 50%. It can't be more. And if you have partial withdrawal from NPS, then it will be tax. Partial withdrawal in 2-3 situations where it's possible, it will be taxable. Then you are forced to buy annuity of the your NPS proceeds. So in on other dimensions, NPS becomes a completely different thing, a very focused and forced retirement product.
Next up, Mr. Patel asks if you could tell him the difference in the yield of regular and direct plans of different fund categories.
Yes, absolutely. That is why they are designed as one. Direct plans have higher returns simply because they are not supposed to pay the sales commission, and that is how the regulators have mandated it, and every fund company is following it. And now after 3.5-4 years, we realize that in some categories the return is far more meaningful. Of course, when you look at the NAV, sometimes you find a nominal, but there are fund companies where we see that the difference in the regular and direct plan is far higher than others. So direct plans will always yield higher return as compared to regular plans.
Next up, Harin says that sometimes both equity and debt funds fail to do well. How can he cope with that? And is investing more money in arbitrage or accrual funds a solution?
No, when debt funds do poorly, when interest rates go down, or if yes, there is a possibility that accrual fund will provide him or continuity, or a liquid fund will provide him. But in those times, even those returns will be so low. Liquid funds are going to be delivering you barely something more than what you can get from your savings bank account in near future. So it is unlikely to be you are unlikely to be very excited about those kind of returns. Yes, there are occasions when equity and fixed income both struggle, but I think that's that's part of the game. I haven't come across a prolonged period of time when fixed income is doing. In fact, there is an inverse relationship. When equities do well, that is generally the time when interest rates are going down and bond funds don't do well. And when interest rates are generally very high, then that's the time when equities struggle. But that is generally speaking, on a broader time frame. It may not be so. We can see some kind of aberration, but that is the time for which you should not be investing in dominantly equity. But you should not be carrying a dominantly equity portfolio with a narrow time frame anyway.
Next up, Mr. Jairam Prasad, who is recently retired, says that he has made arrangements for regular income for the next 5 years. He asks how he should park his retirement corpus.
There are 2-3 things which one should keep in mind. One is that you should invest in a manner that you are not exposed to huge risk, and the way to do it is invest in a conservative vehicle and spread your investment in a manner that you are able to eliminate the possibility of catching a market high. So this is an important money. So these are 2 things which you should keep in mind. Consider a balanced fund and consider a credible balanced fund, and spread your money so that if you invest today and the money market goes down by 20% and even your balanced fund will go down by 15%. So spreading it will actually average it. There is a possibility that you might miss some opportunity, but that missing that opportunity is worthwhile, and it is good for your stomach. You will not have you will be able to withstand the market volatility much better. Then comes withdrawal plan. So while looking at return, you have to look at 2 things. One is the return, and the other is the taxability. If your investments are to be held for next 5 years, which I am confident that in a 5-year time frame, a balanced fund is going to definitely beat fixed income return, unless there is a calamity. And to reduce that calamity, you can add a third layer, which is don't invest all your money in a single balanced fund. Spread it over at least 2 or 3 funds, so that you are not overly dependent on one fund manager's failure. And if that happens to be the one in which you invested most of your money. So these are 3 things which you should keep in mind in terms of managing your own risk. 5 years from now, the money would have been fully invested, will be fully deployed, and then it will still be invested for next 2 years. If you're spreading your investment over the next 3 years, your money will still be at work for 5 years, and it would have given you a decent return. You would have eliminated the possibility of catching a market high, and all the returns that you will derive from there will be completely tax free, because you are through with your investment time frame. And then, depending on that, I would say the conservative withdrawal rate from a portfolio of that kind, after 5 years, the money that would have appreciated, withdraw 5% of annual withdrawal rate. This will ensure that your money is growing. Your money would have grown, it will continue to grow, and you are withdrawing a very small part of it, and the money will not only grow, but this kind of plan will ensure that you are able to build a inflation adjusted income framework for yourself.
Shashank says that he has parked 85% of his savings in gilt funds and is waiting for a correction to start SIPs in pure equity. He says that memories of 2008 are fresh in his mind, and he asks if this is the right approach.
No, this is the wrong approach. If he has invested in a very conservative vehicle which is generating decent return, but the whole idea behind SIP is that you should put the money to a plan. If you are waiting for the correction and then to start your SIP, I don't understand the logic. If you are trying to time the market for a one-time investment, it was still understandable, though wrong, because I think most investors will not be able to time it perfectly or reasonably. So I think the next best thing is to start your SIP now. People have been waiting for the correction for the last 2 years. There might be a correction. I'm not saying that there may not be a correction. There is a likelihood that there will be a correction. There are variables about which we should be apprehensive about the market. The market has gone up steadily up. The economic numbers are the economic fundamental numbers are not showing great promise. Despite that, I would say that start your investment. And the whole idea of SIP is that markets will correct and you will be able to benefit properly. But if you do it over a 3-year period or 2.5-year period, assuming that market keeps going up for another 2 years, there will be great pressure built on you. Most investors miss great opportunity waiting for that correction. So that is why, for ordinary people like us, it is very important to be on a disciplined framework. on a disciplined approach to investments than trying and timing it.
Suman says that some funds have a 4 to 5 star rating but are not ranked even among the top 10 in terms of returns. How does he interpret this anomaly?
Because the star ratings are based on risk adjusted performance, which means there is a possibility of some of these funds being very superior and consistent, and that is why they have got the ratings. But generally speaking, the top rated funds also have superior returns, because there are two components to these star ratings. One is that how they have done and how volatile they have been. So if there is a fund which has done very well, but it has been extremely volatile, it can have a lower rating. So I can understand the converse of it, that there are superior performing funds which do not have a top rating. But generally speaking, the top rated funds also have a reasonable return. So it's a combination of risk and return, just not performance. That is why sometimes you see the disconnect, and consistency is rewarded for while assigning these star ratings, and it is an entirely quantitative process. We do not sit and decide on the ratings. It is a mathematical formula based on which the fund ratings change every month.
Next up, Tapan asks, what is the best measure to evaluate fund returns? Is it CAGR, XIRR, or absolute return, especially in terms of SIPs?
Absolute returns are not meaningful, and XIRR or CAGR is the only way to do it. And in fact, from my standpoint, CAGR and XIRR CAGR and XIRR is the same thing, because you are doing the XIRR for a cash flow, because there is a cash outflow. You are investing 10%, 10,000 rupees a month. So your 10,000, and if you do your SIP for you have been doing your SIP for last 5 years, you need a different formula, because in SIP your first money was invested for 5 years, the next money was invested for 4 years 11 months, and XIRR formula actually factors the return given that different amount of money has been at work for different time period. So CAGR and XIRR is the same thing, except that XIRR formula is used for varying time period of the capital at work.
Mr. Bhaskaran says that he invested rupees 50,000 in a mutual fund a week ago, but the units are still to be allotted. He has called the fund and sent several emails, but he has made little headway. He asks what his next step should be.
He should look for the investor. There's a person responsible for investor services, and he should immediately get in touch with it, and he should raise this issue. This is wrong. I think 3 days are good enough. If the money has been realized, next day he should get the account statement. If he has provided his email ID, things don't travel on the snail mail anymore. He can, if he has provided his email ID, and if he has given his mobile number, and if his KYC is done, there is a possibility that if he is a first time investor, the KYC takes little longer. But if he is an old investor, he invested a week ago, and if he hasn't got his account statement and the money has been debited from his account, he should raise it with the investor grievance officer in the mutual fund. And if he doesn't get a response in 2 days time, he should go to a grievance redressal filing system at SEBI. SEBI website has a mutual fund grievance redressal mechanism. He can file his complaints online, and most of those issues get resolved very quickly.
Thank you, Dhiren. Any final comments?
Keep it simple, and hybrid funds are very important from that standpoint. And I can't explain more, but don't have the wrong expectation. Of late, I have been witnessing that many investors are looking at some of these hybrid funds as a bankable way to derive income. That will create a wrong that has you have started believing in the wrong thing from these balance funds. They are a relatively more stable vehicle by design, and expect exactly that. They provide you the convenience, they provide you with the tax efficiency. If you are not chasing high return, if you are chasing greater stability, come to them for convenience. And for most investors getting started, this universe of hybrid funds should be the only universe you should consider. Don't go beyond them.
Thank you all for joining us.
Thank you.
Join us next week for our next Investor Hangout.